You know, in the world of high-stakes corporate battles, you hear a lot of jargon. But there's one term that sounds like it's straight out of a spy movie, the poison pill. It's a tool for the boardroom, not the battlefield. So let's dive right in and figure out what this powerful and honestly super controversial defense is all about.
And that name? It is absolutely intentional. Just like a spy's last resort to avoid being captured, the corporate poison pill is designed to make a company so financially messy, so hard to swallow, that any hostile acquirer just has to back off. It's the company basically saying, go ahead, try to take me over. You will regret it.
But here's the first thing you really need to get. The main goal of a poison pill isn't to kill a deal completely. Not really. Think of it more as a massive power move. It's designed to force a potential buyer to stop what they're doing and come to the negotiating table. It's all about the board taking back control of the whole process.
Okay, so how does this thing actually work? Well, the secret sauce, or, the poison, is a concept called dilution, and it is an incredibly powerful way to build a defense wall around your company.
It all goes down in 3 simple steps. First, the board just adopts the plan. They issue one right for every single share of stock. Now these rights, they're totally dormant, basically worthless. They just sit there waiting. And then, you get the trigger. An outsider, some hostile firm, starts buying up shares and hits a specific number, let's say 15%. Boom. All those sleepy rights suddenly wake up, and they let every other shareholder buy brand new shares at a huge discount. So what's the end result when you suddenly flood the market with all this cheap stock for everyone except the person trying to buy the company?
Well, this is where the math gets absolutely brutal for that would-be acquirer.
And this chart really shows you the raw power of that dilution. Just look at this example. An acquirer spends a ton of money to get a 15% stake in the company, but the second they hit that trigger, the pill activates. All the other shareholders get to buy those new, cheap shares, and suddenly there's way more stock out there. And here is the punchline. That 15% stake they worked so hard to get, poof, it's instantly watered down to just 3.4%. In a flash, their voting power is totally crushed, their investment is crippled, and their whole takeover attempt is pretty much dead on arrival.
Now, a defense this extreme really makes you wonder, why did anyone even need this in the first place? Well, for that, we've got to jump in a time machine and head back to the 1980s, which was basically the Wild West for corporate takeovers. This wasn't just business, it was war. So in the early 80s, you had these guys called corporate raiders running around. In response, a lawyer named Martin Lipton invented the first Shareholder Rights Plan back in '82. And it didn't take long to catch on. By 1985, the Delaware Supreme Court gave it the official green light in a huge case. And just like that, the poison pill was a permanent part of the corporate defense playbook.
Of course, the threat itself has changed over the years. Back then, it was all about bust-up takeovers. Raiders would buy a company just to break it up and sell off the pieces for a quick buck. Today, things are a bit more subtle. You have activist investors who are trying to gain influence with a smaller stake. But the pill? It's still a pretty relevant defense against both kinds of threats.
And the pill itself has had to adapt too. It's not this one-size-fits-all thing anymore. In the modern era, we've seen it used in some new and interesting ways, including in one of the most talked about takeover fights in recent history.
For example, you have something called the null pill. Its job isn't really to stop a takeover, but to protect a company's net operating losses. Just think of these as valuable tax credits the company has from losing money in the past. To protect that asset, these NOL pills have a super low trigger, like around 4.99%, to prevent a big change in ownership that could wipe those tax savings out.
But of course, the most famous recent example is Twitter versus Elon Musk back in 2022. Remember that? As soon as Musk revealed he'd bought a big stake, Twitter's board moved fast and adopted a classic poison pill, and that one move was absolutely critical. It stopped him from just quietly buying up more and more shares and forced him to make a real formal offer to the board.
And this is so important. The pill was never actually used. Just the threat of it was the real weapon. That threat is what brought Musk to the negotiating table, it gave the board time and leverage, and in the end, it helped them lock in a deal with a 38% premium for shareholders. It worked perfectly. So all of this brings us to the huge debate at the heart of the poison pill. Is it a shield to protect shareholders and get them a better deal? Or is it more like a cage that lets bad management entrench themselves and avoid being held accountable?
So on one side, people say, hey, it forces buyers to pay what a company is really worth and gives the board time to shop for an even better offer. But the critics fire back that it can protect underperforming managers from getting kicked out, and it can send a signal to the market that the company isn't open to deals, even if a deal would be great for shareholders.
And this isn't just an academic debate. It has real-world consequences. Big, powerful investor advisory firms are really skeptical of poison pills these days, and all that pressure has actually changed the game. Now, a lot of pills are short-term, designed to expire in just a year. They're becoming a temporary fix for a specific threat, not a permanent fortress.
So in the end, we're left with this fundamental question. A poison pill gives a company's board an incredibly powerful weapon, but when they decide to use it, who are they really protecting? Is it about getting the best deal for the shareholders, or is it about protecting their own jobs? That's the billion-dollar question that's still being debated in boardrooms today.